our panelists and attendees to hear our next great panel about executing the transaction. So with that, April and Krista, will let you transition our speakers.
Thank you.
Thank you.
Thank all of you for your great insight and great input. And let me just start to go over who makes up our next panel as they're coming on board with us. So thank you everybody for participating. For those of you who may not have been here at the very beginning, I just want to remind you that we will have a question and answer period following this panel, and we ask you to raise your hand. We have disabled the chat feature because of our compliance. Back office does not allow for us to have a chat feature in these kinds of calls. So with that, we just ask you to raise your hand and then we can address your questions. So we have a great panel talking about executing the transaction. With that, let me introduce to you Kimberly Wright and Jessica Monroe with Revolve Law Group, and they are attorneys who have understandings about tax mitigation strategies that we'll be talking about. And then we have with us Fred Whitaker, who's the managing partner at Cummins and Wright, and he is an M&A counsel. And I love, Fred, your quote here: having operated a business and been in-house counsel to a large 3-generation family business, I tend to think and act more like an owner than just an attorney. This gives me the unique ability to be an effective outside general counsel. Love that quote. That's a great one.
Thanks.
And then we have Michael Yee, who's managing director of Newport Valuations. And Michael is our valuations expert. And hopefully, Michael, you heard that question that was asked a little bit earlier, and we can have you address that question as well. And then we have Mike Chambers. Mike Chambers, who's the Executive Vice President and Chief Banking Officer for Partners Bank of California. And he will be talking about lending and things to consider there. And we had some of those questions in the first panel as well. So thank you to our esteemed panelists for being here. And you can unmute yourself when you're ready to answer questions, and we ask you those questions. And I'm going to start with Mike Chambers. Mike, talking about a very, timely question that we're hearing business owners ask. So we know that many business owners took the PPP loan, but what if they took that PPP loan and now they want to sell the business? How is that treated?
Yes, the probably most famous loan in the history of banking, the PPP loan. I think PPP acronym should stand for the patience loan, because that's how long it's taking to get the forgiveness cycle. Listen, if you're selling a business right now, or you plan to do it really at any time for sure in 2020, you're going to have a plan for the PPP program. Just to give you guys some metrics on this, the SBA did $5.2 million PPP loans. They did over $500 billion worth of PPP loans. I'm only saying this because they normally do significantly less than 50 billion. So your SBA, which are working tirelessly, did more than 10 times their normal volume. And they're being kind of dictated to by the United States government. Now, all of this is wonderful. If you're with the bank that embraced the PPP, typically banks either embraced them for you or they did not. There's a long line to get forgiveness. What we know right now is hundreds of thousands of applications have been submitted to the SBA, and they are not reviewing any of them yet. So you are at minimum 60 to 90 days away from hearing back from the SBA. So plan for that. To put you at ease, I think it's a question of when, not if. And you can ask me questions about the PPP later or offline if you want to. I think it's really a question about fraud, not forgiveness. But as we know, when we read the newspaper, this is still going to take some time, and there's a lot of political wrangling. And they're trying to come up with something that's a one-size-fits-all solution, which they did, but they're trying to do it as well to avoid fraud. So just expect this to drag out. The things I can tell you, if you have a PPP loan, well, first and foremost, get good advisors. And if you have one like Fred Whitaker, who suggested in our rehearsal, that not only should you keep good records, which by the way, you should do as a business owner, even if you're not about to sell, have good records ready, and also set aside some time in the future to go back and readdress any changes that they might make. Again, I don't think they're going to bulk on forgiveness. They're just going to bulk on how you go about getting it. But as Fred suggested, build in a set aside. You know, if you're selling a business right now, tell the person that's selling your or that's buying your business, well, I'm so confident and I have the records and I'm ready to apply for forgiveness. We'll set aside that money and we'll deal with it when the United States government comes through. Because while I feel very confident that forgiveness will happen, at the end of the day, you made a contract with ultimately the United States government. So if they change their mind for any reason, guess who's going to win that one? So address it on the front end. It's just like any other problem. Communication up front will cure a lot of problems after the fact.
Lorraine, could I just comment on that real briefly?
Please do. Please
Yeah,
do.
the reason that I suggested a set aside when we were talking about it in our rehearsal was that the change of control rules in the normal SBA loan process didn't change because of PPP. And so we just closed 2 transactions. One where we were selling the assets of the company, and yet our company still existed after the close. We ended up having no problem, right? Our borrower still existed for the bank and for the SBA. Where we had a problem was where we sold the stock of the company. And so the borrower disappeared, and that was a change of control event. And the bank and the SBA had a fit, and basically you weren't going to get forgiveness. We just had to pay it. So yeah, I think a set aside is really prudent. And also, as you're going through, if you're going through a deal right now, the structure of the transaction really is important with respect to your PPP loan.
Great points that maybe not a lot of business owners have thought about. Okay, John, go ahead.
Yeah, absolutely. All right. So as we've already seen, but we know that many business owners, and this is a question for Michael Yee, many business owners wonder if they know the value of their business. So what is your process of ascribing a value to a business?
And maybe, Michael, if you heard that earlier question about valuation, if you could address that as well.
Yeah, so let me talk about valuation. So when we get engaged, we sometimes ask the client, okay, what is your understanding of your value? And they said, well, my friend told me he's in the same business, so X times multiples. I just did a valuation for estate planning and trust, and we use X, Y, Z, so that's the value. Now, there are many standards of value. You hear about fair market value, you hear fair value, investment value, intrinsic value. There are many standards. And also there are many different purposes. So there is a value for gifting situations. There's a value for sale purpose. Litigation depends on which side. The value could be quite different. ESOP could be another one. So there are many different purposes. So when we're talking about one company, same company, depends on the standards, depends on the purpose, the value could be quite different. It could be 5 million, or it could be 10 million. So since we're talking about M&A, you want to capture the full value when you're selling your company. You don't want to use your trust and estate planning value to sell your company or something else. So I just want to mention about that.
And did you hear that question about what if you have a large client list and it hasn't yet been monetized and there's no real way? I mean, how would you approach that from a valuation standpoint?
I mean, that's a tricky question, but valuation is a forward looking. So it might be realized some point in time. And one way possibly might be having some kind of earn-out situation within a year or two. If it happens, and they'll get a portion as an earn-out. So, we might see some of those type of deals. But it's really depends on each situation.
Yeah, great answer. Okay, so Fred, I'm going to turn to you. From an M&A counsel perspective, what are some of the things an entrepreneur who's selling needs to consider?
Oh, I think there's, it could be a really long laundry list, but if you just kind of focused on maybe 3 or 4 things. The first is whether you're working with an advisory group or whether you're working with a lawyer or both, really pay attention to the letter of intent phase because that's the roadmap for the deal, right? And the structure and all the big business points are going to be in that document. And even though it's not binding, what it does is it prevents retrading by the buyer later after they've done things and they've done their due diligence. I think a second big issue that many entrepreneurs don't realize is that really for the last 10 years or more, every deal, whether it's a stock deal or an asset deal, has been on a debt-free, cash-free basis. And you think that's great, I get to take the cash out of the business. But the issue is that they want to have it with the actual working capital that's needed to run the business. So that means your accounts receivable and your inventory are going to have to support the normal accounts payable and the normal current liabilities. And there's going to be a lot of negotiation around that number about how much is going to get left in the business. And if you don't negotiate that net working capital number correctly, you could, at the end of the day, have to give money back to the buyer or put more money, leave more money into the business. I also think that people don't realize how important your key employees are to the deal. You know, I love going from the very beginning of the seminar all the way to now and how incredibly important succession is. You know, the last session, you talked about ESOPs, you talked about financial buyers, you talked about strategic buyers. I think too many owners of the businesses really think, okay, my competitor's going to buy me. I don't need to have any of my staff. I'm going to get a great valuation. Well, that's only one form of exit. You know, and that competitor who's strategic may not be in the same geographic area you are, and they're still going to need people to operate the business. I do a whole seminar for people called Operating Businesses Need Operators. So if you're an ESOP, who are you selling it to? Your employees. Those are operators. If you're leaving it to your kids, either one of them's got to be a good operator or they got to have great operators behind them. You're selling to a private equity, either you have to be the operator or your team have to be the operator. And then if you're selling to a strategic that's not in the same area, you need to have great operators. And you need to make sure those people are contracted up and incentivized well to help you carry through the transaction and into the next phase.
Great points to consider. John, go ahead.
Sorry, I said to unmute myself. All right, so this is to Kimberly Wright and Jessica Monroe. There are many considerations when an entrepreneur is selling and strategies to mitigate taxes. Could you describe one strategy that you assist entrepreneurs with?
Yes, so in California in particular, we have the lovely 13.3% California income tax rate plus when selling an asset, the federal capital gains tax of 20%. But under Internal Revenue Code 453, there is one strategy in which the seller of an asset can enter into a long-term installment agreement, which is defined as any sale when a payment is received at least 1 year after that sale date. And therefore, under the sales proceeds can be received and split up over that time period, which may have multiple business purposes. But then in any given year, the tax is only going to be on what's actually received. And so, for example, if you have a seller selling $5 million and they agreed to do $1 million a year, then they're only going to be taxed on that $1 million, and the later portions will be taxed in those subsequent years. But a lot of these transactions can go over a longer term, anywhere from 15 up to 30 years. And an additional feature could be receiving interest only, which of course interest is taxable income. But then if you're deferring the sales proceeds until the end of the term, whether it's 15 or 30 years, that capital gains tax wouldn't be due until that point in time. And while this transaction can happen between any seller and buyer, that they're customizing their deal, there are facilitators that can come in and facilitate the convenience and the reliability of the structure, because a lot of times buyers aren't going to want to be stuck with a long-term contract like that. So that's one option.
Great. Thank you for starting to explain that complicated idea of an installment sale, but we'll get more into that in just a moment. Fred, back to you. We've heard a little bit about how there's a great time commitment for the business owner when it comes to thinking about, going ahead and making that succession happen. So when it comes to this idea of the transaction and the transition, can you talk a little bit about the time commitment for the business owner? Oops, you're still muted. You're up. Right.
There we go.
There you go.
Sorry about that.
Yep.
Yeah, I think business owners really often underestimate how long it's going to take and how much time it takes for them. Like it was said in the previous panel, a typical transaction can take 6 to 9 months. During that 6 to 9 month period, the business owner, in my view, should expect to spend about 50% of their time on the transaction. The other thing that they don't realize, we talked a little bit about their key employees. There are going to be certain key employees that are going to need to drive the ability to put data into the data room for the potential buyer to look at, and then to have to do that work all over again as I need to build the schedules to the agreement, right? So just because you gave it to the buyer in the data room, a lot of people don't understand that that's just giving them the information. Now you have to assert the truth and accuracy of the information, or the disclosures about things that aren't really that great, all need to get attached to the agreement, and that work has to happen all over again. The buyer and their due diligence people are going to be asking lots of questions of you and some of your key staff, and it's a distraction to the thing that actually you do every day to make money. And I think entrepreneurs often underestimate that level of commitment that's going to need to be undertaken to get through and close the deal.
Yeah, that's a lot of time, and oftentimes it seems burdensome in that process, but it's good to know ahead of time what that could actually look like. So John, I'll turn it to you.
Yeah, and we're going to go back to Michael Yee on valuations. And when we look at improving the value of a business, we know there's a lot of avenues, but what are some of the most effective ways that someone can improve the value of their business or company?
Good question. But before I answer that question, I want to kind of piggyback what Fred said, timing. We sometimes see clients trying to do estate planning. So they do gifting of certain percentage, and within a couple of months, they sell their company. So that's not going to sit too well with the IRS. You have a value of $5 million for gifting purpose. Then you sell the company for $10 million in 2 months or 3 months down the line. So you got to be careful of those kind of situations. You got to plan for those things. So instead of 2 or 3 months, have a 6, 7 months down the line, or do estate planning before, so you don't have this kind of short period. In terms of improving the value, so there's some of the steps you can help. First of all, you want to get your audited financials. So if you're planning to sell your company, get your audited financials in place. Don't try to have audited financials when the buyer is knocking on the door and they have a LOI in place. Now you say, sorry, let me go back and try to get our audited financial done. I mean, that's going to be 5 months, 3 months, 4 months period trying to get audited financials. So get your audited financials done, get your legal audit done, get your HR audit done, get the certification, ISO, whatever that might be, get those things done. And also having strong management team in place, clean up the organization structurally, physically, improve the weaknesses. There are many things you could do. So we had a situation where we got engaged, and when the owner said, so the engagement was for state and trust situation, and they said, Michael, by the way, we are thinking about selling the company perhaps a year or a year and a half down the line. The father was the owner, 2 sons got involved, 2 sons didn't have money to buy out the father. So small company, they make a sensors, $8 million value we came up with. We helped the company go through a lot of improvements. So a year down the line, they sold for $12.5 million. So $8 million to $12.5 million. So those kind of things that you work with advisors could improve the value of the course.
That's great. The point of that it's a different valuation for estate planning versus selling, and separating those two with some time so that it doesn't come back to bite you makes a lot of sense. And that's a great transition to Mike Chambers on the lending side. So Mike, what do banks look at when they're looking at lending for an acquisition? Here we're talking about all these things. Talk to us from a bank perspective on what makes a bank feel most comfortable.
Well, I'll build off a lot of points that this panel and the previous panel did. So I'll just try to give some analogies and some examples to it. But the previous panel said a phrase that resonates with me: get your house in order. So the first picture I'd like to paint for you, if you're going to sell your multi-million-dollar primary residence, the first thing you're going to do is clean it up and remove all the clutter. The other thing, our panel mentioned about build out your internal team. We've touched on that, and I'll touch on it more as we go. But build your extended team. And listen, I'm not getting a kickback from all these folks, but you should be talking to Michael Yee, and you should be talking to Revolve Law Group, and you should be talking to John, because as a banker, look, you're either going to find a buyer that's going to give you all cash. Well, then don't listen to what I'm saying. But if you can strengthen your financials, all you're doing is widening your market. Most buyers want to come in to get financials, and let me just tell you, the regulators trained me to not believe you. So go get experts to tell me that, hey, it's not on me, regulator. I didn't make the mistake. Put the onus on Kim Young and put it on Mr. Fitzpatrick, because we're going to believe them, and we have an audit trail. I'll give you some examples, and Michael Yee mentioned this too. There's two common mistakes I see. Number one, a lot of businesses go from mom and pop, and I love the loyalty factor. I've got some great business owners, but now they're 20, 30, 40 million in revenue, and they're still using a bookkeeper. They're still using the uncle or the college friend, or and I look at their literally their filed tax returns, and it's a tax preparer. No, get a licensed CPA, especially if you want to gain some solidity, some solid valuation. Mr. Yee brought up audited financials. I'll give you two real life examples that came across my desk. One was an acquisition. They're buying a business. It was August of 2018, but just for some perspective, this was the seller telling me, hey, I've got somebody, they're giving me a great price. They just need the financing. Will you do it? And I had to look at somebody I've known for years and said, we've talked about this. The last filed anything that you can give me is your 2018 tax return. Your 2019 is on extension, and your June interim statements for 2020, mind you, it's August 20th, is self-prepared by somebody who's not a licensed CPA. How am I supposed to have faith in the middle of a pandemic to do that? That is real. I'll give you another example, because everybody right now, if you're interested in selling your business, it means what? You own a business. These are things to think about, even if you're not selling. I had somebody else that came to me and mentioned, hey, I'm in technology. I'm in the middle of a pandemic. Technology's never been needed more than ever. I'm going through the roof. And same thing, sure, I'd love to give you an extra $2 million, the next day after you called me up. But again, the last thing I have on file was a 2018 tax return, right? So it's really important for you to think that way. These are good practices, even if you're not selling it. Obviously, just like if you buy a big commercial real estate building or you go buy a primary residence, you're gonna have a third-party valuation. I do occasionally come across the business owner that, well, I don't wanna spend $5,000, $7,000. Well, you're about to buy something for millions of dollars. It's worth it. What if you're wrong? The point was made earlier too about have someone different than you. You tend to get a little emotional about that. You don't realize it in the moment, but it's good to have third party kind of flat-headed, my pulse isn't racing analysis of the situation. Now I mentioned build your extended team. John mentioned about building your internal team. That's also critical, because what you have to realize is you've probably been selling to your bankers for all these years how important you are and the edge that you have, and believe in me. Well, again, our upside is 5 to 7%. Our downside is 100%. We're not investors. We're supposed to make completely safe deals. So whatever your valuation is, that's just step one. Now we got to understand, how are you going to keep it? And in the history of banking, 100% of the time, yes, get good projections like the previous panel said, but 100% of the projections I've ever seen says you're going to be wildly successful. And what we know empirically is 100% of the businesses aren't always successful. So be prepared to defend those projections and just know that I am trained and required and monetarily incentivized to not believe your projections. As a rule of thumb, banks assume that when an ownership transitions, we are going to see at minimum 20% drop off in your revenue. That's if we think you're good. So just prepare for that. And the things that we look for is number one, I love the quote, operators who operate. You need somebody to run your business because you're stepping out. And then two, what's your revenue stream like? Who are these customers? Are they going to stick around? Who are your salespeople? Because those are the two biggest things that we look for. So prepare for it and just know that that's what you're up against when you're trying to get what I think is the cheapest non-dilutive of ownership financing possible on the planet.
Yeah, and to your point, Mike, you're regulated. The regulators have their say. So it's not just you being a bad guy or anything. It's that you've got regulators, just like we have regulators in our business. John, I'm going to turn it back to you to ask another question. Oh, did somebody want to make
one point on that? Just so you guys realize, when you're talking about a bank, our whole ability, like if I asked you to invest in something at 5-6% with all the downside of losing all your money, you're probably not going to do it. We only do this because if we follow our regulators, we're not reserving dollar for dollar. So you kind of have to help us build the tools. So I may be putting down a third of my money so that 5 to 6% feels more like 15 to 18%. But you have to help the bank do it. Otherwise, it's just not worth it on the downside. Sorry, go ahead.
Thank you so much.
Rory and I have a comment.
Yes, go ahead.
So Mike just mentioned about having proper advisors get involved up front. So we have a client doing manufacturing. The company's worth about $40 million. The CEO, who is a smart person, decide not to hire investment banker.
Yeah.
Decide not to engage M&A attorneys up front. So she was dealing directly with the buyer. So it took us so many months to provide the information they were looking for. And it also took us so many months to negotiate going back and forth and also running the company on top of that. So they could have sold before pandemic hit at $40 million because it was a good offer. And they were not able to close because so many things going on and dealing directly without investment banker involved. So they missed that opportunity to sell the company. Now they got hit with the pandemic, so they lost sales big time. Now they're not worth 40 million anymore. So it's so important, unless you have that background, to bring advisors early on to capture full value of the company.
That is such a great example, and not to be short-sighted, that bringing in the right kind of advisors, M&A counsel like what Fred does, and other people alongside you in the process is critical. With that, I'm going to let's see, John, I think I'm turning over to you for another question.
Yeah, well, here's another question for Kimberly and Jessica. And the question is, just if you could give us an example of what using the installment method has actually looked like for a client.
Yes, of course. To that point, when the seller is looking to do something like the installment sale, which obviously is being done for tax mitigation purposes, we will not actually get involved and assist without these other advisors. We want the CPA involved. We want the financial advisor involved. We want the M&A attorney involved, because these are very sophisticated transactions, which involve, it's customized. So it's not as simple as one size fits all. So for an example, we were recently dealing with an individual doctor who was selling the medical practice. He owned about a percentage of it, and his percentage was going to result in just shy of $5 million in sales proceeds. Now in California, based on the California state tax and the federal tax, you're looking at about approximately $1.6 million you're going to pay off the top to begin with. So the net sales proceeds were about $3.3 million, which is painful. $1.6 million that you're giving to the government is a very, very uncomfortable situation to be in. So we come in and we analyze what a potential structure could be to offset using just time and creativity to push this tax obligation out into the future. And what this particular doctor decided to do was to consider, under the installment method, a sale whereby he would receive just a percentage, an interest-only payment per year. So for example, on that $5 million, he was looking at interest-only payments of $200,000, meaning that his principal was going to sit with a facilitator for the term he chose, which was 30 years. Now, a lot of people are not interested in giving up $5 million to receive $200,000 a year. But again, working with the advisors, the financial planner, all the individuals involved, we were able to arbitrage the situation so that doctor had access to a line of credit that was really inexpensive. It was no more than 3% per year. Now, the interest-only payments this doctor was receiving from facilitator was offsetting the cost of this line of credit. So instead of doctor receiving $3.3 million in proceeds at the sale, doctor actually received $3.8 million. So what does this look like with tax planning over time? Had doctor just taken the $3.3 million and invested it with the financial planner, doctor would have received $19 million at the end of 30 years. With the tax planning and arbitrage, doctor will actually end up receiving $26 million at the end of 30 years. So that's kind of a high bird's eye view of what the transaction looked like. But I just wanted to highlight, with proper tax planning and the proper team involved, whereas you could have received 19 million, you could receive 26 million. So it does provide benefit for you to consider any sort of tax mitigation strategies that are available to seller.
Along with that, what I would say is certainly the larger that transaction is, the more someone might want to talk to you about it, because there are significant implications if it's going to be paid out immediately. In the presentation I'm going to do a little bit later on retirement income planning for business owners, we'll talk about some other tax strategies as well, in addition to this idea of the installment sale. So
Maureen,
that,
could I just
yeah,
comment real quickly on that
please,
too? I mean, it goes back to Michael Yee's point earlier of really needing to plan in advance, because you could definitely have a combination of different strategies with respect to the proceeds and how it would receive the proceeds, and how to structure the transaction. And you can't do that all in the last minute before the closing. And certainly some of the tax attributes, or if you're going to do some gifting, all, like Michael said, had to happen ahead of time. And you need to give Jessica and Kimberly the time to actually plan through the strategy well for your individual circumstance.
a great point.
Sorry,
No,
I just want to say
that. Go ahead.
Go ahead.
No, go ahead. Go ahead. You're probably going to say what I'm going to say, so go ahead.
To that point, we had a situation where somebody was selling, I believe it was a large amount. It might have been $20 million. It was just astronomical. And they brought us in and we couldn't do anything because we needed time for them to understand what was happening. But they were closing, and I think it was like 7 days or less than 14 days. And I mean, you can only imagine being a California resident paying taxes on $20 million. It was sad. It was very sad.
It's unfortunate, and the point that I was going to drive home is doing your planning and doing financial planning, and it isn't for business owners specifically, so that you know well ahead of time what your options are is critical. With that, I'm going to turn it back over to Fred and talk about, Fred, you talk about how key employees play a critical role in this whole transaction process. Can you tell us a little bit more about that?
Well, yeah, so certainly, I mean, if you look at your operation and what do you need to get conveyed to the buyer, Let's just forget the idea of the right-hand person or the operator who's going to be your successor. I advocated for that earlier, but just trying to get through the transaction. If you're trying to get through the transaction, your CFO's got to be intimately involved in the transaction. That CFO is probably going to need to know they've got a home to go to after you sell, right? So you're going to need to incentivize them to help carry you all the way through the transaction and make sure that they help you well and they're not out looking for another job. I also think your vice president of development or vice president of sales, because sales are revenues, right? The buyer is buying revenues. And if they don't believe your salesman, your lead sales team is coming with the deal, then the deal very well may not happen. And you'd be surprised, I love Mike was talking about how projections are always rosy. The buyer actually is looking at the projections. I know the bank discounts them, buyer discounts them too, but they're really looking at projections to really see how much value they're going to get. I mean, they're buying on history. They always buy on history, but they're looking at the future to see what type of return above and beyond, the multiple they're going to get. And so the only people that can actually drive those projections are the top of your sales team. And so I see owners make a lot of mistakes where they try to do everything themselves. They try to surreptitiously get the information out of their accounting department. They try to build the sales projections themselves. And inevitably, the deal starts to having issues in the middle of due diligence because stuff isn't right. And that's because the owner didn't go down and trust some of the key staff to get him or her the information that they need to be able to convey to the buyer. And it frankly means that you're going to have to make sure that there's a home for those key people when the transaction closes and that they're incentivized to help you close the transaction.
Great points. And you also talk about, compensating those people in a sense.
That was the incentivize. Incentivize. You're going to need some stay bonuses to make sure that those folks have the incentive to stay focused on the transaction and not be out looking for jobs.
Yeah, we've seen business owners who at the last minute were, being held hostage by certain of their key employees, and a little bit of money in that regard can go a long way. So with that, John, next question.
Yeah, well, we'll go back to Mike Chambers. And Mike, when we're thinking about family businesses, how should a family business prepare for future generational transitions?
That's a great question for us. I mean, Partners Bank, by the way, is just a backyard business bank. So a lot of our relationships are kind of warm and cozy. We typically keep folks for 5 to 10 years. We touched on plan ahead, but what does that mean? So if you want to leverage the cheapest financing available to business owner, which is an FDIC approved bank, and it doesn't matter if you're selling the company down to son or daughter, sometimes you're just gifting it, but they need to be in position to just keep a $3 million line of credit that you've had for years. Either way, you have to realize that all banks run off your last 3 years tax returns. So we've heard plan ahead a lot, and that's just a concrete example. Now, if you're going with Bank of America or the bigger banks, you definitely need the 3 years. If you have lucky enough to have a relationship with a smaller community bank, we'll give you an edge on that. We'll understand your story a little bit better. But I think what's really important for folks to realize is, and Peter Greer mentioned this, you don't always get to pick your time. Like, I'm always talking to them about what ifs, right? So we get a lot of folks that are kind of coming up the curve. They're not the $500 million company yet, or when they're starting, it's a couple million, 10 million, 20 million, and they're building their curve. And they all have these plans of, yes, someday in 2030, Mike, I'm going to hand it down to daughter. Well, what if you have a health issue in 2 years, right? What if something cataclysmic you've never thought about happens? What if marriage, divorce, children, something happens to the person you thought you're going to hand it down to and they're not available? Peter mentioned to have 5 people. Heck, I will take more than one because most folks have just one in mind. One of the things I tell those folks is that if you built yourself to be so important in your business that I need to require key man insurance, which is something that I do, well, that means you don't have a good management team underneath you. And if you're dealing with a smaller bank, heck, if you're dealing with a bigger bank, make sure when you're doing your lines of credit renewals or whatnot, make sure you document who could run the company without you. and start building that in so there's a documentation trail of who your leadership team is. That is so critical. There's companies, multiple companies that I deal with where I say, let's pretend right now something happens to you. Who steps up and how are they going to look as a guarantor? And the line I always use, which kind of supports Mr. Greer's comments, I always say, don't wait until you smell smoke to do the fire drill. Like, do the fire drill now. Don't come to me because, you know, something's happening and you're going to pass away in 6 months and I need to replace somebody right now. So examples that we do with that is we say, let's do a test run. Give me who your replacement guarantor is. The answer key is this: banks always want two sources of repayment. Number one, ideally you have 3 years tax returns filed by a properly licensed CPA that says this business is profitable on its own. But we're still required, because of our low yield environment with low upside and massive downside, to say, let's assume that all fails. We have to. What's my secondary source? It's typically you. So one of the things you can do is start building that guarantor. And I have countless examples where I say, have son or daughter apply right now. And guess what? Prepare them. Because I'm going to come back and say that if it happened today, it's not going to happen. But here's how you build your personal balance sheet so you can backfill that secondary resource. The other thing that I'll tell you about, well, 2 points. One, if you're the old school owner that says, I just never want to deal with a bank and never want borrowing, you should probably still take out a line of credit with the bank just to go through the process. They're willing to give you their time as a financial third-party consultant to say, here's what you could have. That may become irrelevant to your children, or even an external person you're selling to, even if it's not relevant to you. Second thing I'll talk about is we introduce real estate into the conversation quite a bit. And there are some complications. You should definitely call Revolve Law Group, because there's some upside and downside to real estate. But some of the upside is it can replace and add collateral support if you have a change in guarantorship. Meaning if you become an owner-occupied tenant as opposed to a renter, maybe there's equity in the building that would support a transition from father or mom to son or daughter as owner, because they're typically not going to be as strong as you. Obviously, that gives you some flexibility options in both how you want to sell for me, I always coach folks. Sometimes the business owner wants to hand it down to the kids, but they kind of want to keep their fingers in the pot a little bit. Well, enjoy being a landlord to the business that you just gifted to your children. Again, in warm up, Mr. Whitaker is a wealth of knowledge. He also said and brought up a good point too. You might have multiple children and maybe you hand one the real estate and the other the business. So there's lots of ways that we're talking with our clients. So if you think that it's on the horizon, I do encourage you to make sure you have a good relationship with your banker. Even if you don't need it, the person that you gift the business to, or even if you go outside your family or your acquaintance, being able to leverage bank financing can get you the multiple that you want and also make sure the business exists. They talked about having capital after the fact, and banks can be a solution for that. So I do encourage you to warm up the relationship with the bank.
Absolutely.
Can I just comment on that just real quick, Lorraine? Real estate is kind of the way in Southern California that entrepreneurs have built wealth, but you got to do it in a tax advantage way. And so, whether it's our firm or Revolve or your CPAs, make sure that you talk to somebody ahead of time because having that real estate inside a corporation, I see way too often. And then it doesn't give you flexibility when respect to a transaction happens. And it's really disadvantageous from a tax point of view when that real estate's trapped in a corporation. And I just see too many companies that have just evolved that way. There's so many better ways to do it with an LLC outside the company.
Exactly.
Yeah,
and when somebody, I'll come back. Go ahead.
Just to build off of Fred's point, yeah, it's really critical that you set it up like a separate business. And just like all businesses, you should start with the end in mind. And that's a very critical point, just to have movement. But from a bank's perspective, and keep in mind, when you talk to the bank, they don't necessarily care about the tax ramifications as much, right? Because that's your problem with the IRS. We just think of it as, well, gosh, you have a $3 million line of credit. I'm not sure if son or daughter is going to be able to support that from a personal guarantee standpoint. But you bought a $5 million property. We got it properly evaluated at $5 million. And after 10 years of you paying it down, it's now worth, you only have 2.5 million with me. So that's a chance for me to put a secondary lien behind my own first and give guarantor strength. But Fred's completely correct. Make sure you separate that out as an isolated business and start with the end in mind, because that's a totally separate business now that you need to.
And Fred, if it wasn't done properly, and for whatever reason, a long time ago, that real estate was put into the C corporation, and now many years later with gains. Do you have any ideas on that?
Yeah, so the typical way that we've moved it out is, we go get it appraised, and what is the appraised value of it. And then we'll try to sell it out to the shareholders on a long-term installment, or we'll dividend it out if it's not too valuable. We want that real estate out of the corporation. And so we have to figure out what's the least painful way to get it out of the company. If you just distribute it out completely right now at fair market value, you're going to have one heck of a tax consequence. So
exactly. And Kimberly and Jessica, did you want to add anything to that same point? I think
No,
you're on mute. There we go.
yeah, sorry, we're on mute. And I think Fred and Mike are right on point and giving really good advice here. So yeah, just plan ahead, because so many times I'm dealing with the after effects of not planning ahead and having to deal with IRS and those tax implications, and FTB makes it even harder. So yeah.
So with that, let's ask you another question at Revolve. Let's ask you about what are the benefits of doing an installment sale? Can you explain that a little bit more?
Yeah, so one of the benefits that Kimberly was touching on actually is really that time value of money. So in the example that she was walking through, where there was a $1.6 million tax bill that was going to be due on that sale, that tax bill is still due, but if it's due today, you're paying $1.6 million today. If you have it split out with the installment sale and, for example, have it structured out to 15 years, that's worth $694,000 today. Or if you push it further out to 30 years, that's only worth $290,000 today. So that time value of money is a significant factor. And then having that loan option that she had touched on, and like Mike was saying as well, having a bank to go to, when you have a loan where you can resolve that liquidity issue that you're looking to, and then while you can reinvest that in other business purposes, you're going to, have that access to liquidity, which the loan isn't taxable like the sales proceeds would be. And then when you do have a long-term loan, another advisable option is for the seller to look into increasing or just even getting life insurance to cover that tax obligation, because at the end of that long-term note, that tax will be due. And if something happens to seller during that time, and you have life insurance to kick in and pay that tax balance, that's going to be huge for your heirs. And if there's still time left after you pass and then the taxes are due, you can either even further reinvest those proceeds and have more of a cushion there to help. So there are multiple holistic planning approaches to be looked at as part of this transaction.
Thanks so much. John, I'll turn it over to you to ask another question.
Yeah, so we'll go back to Michael Yee to discuss valuations. And so we're interested to know how often a business owner should update the valuation, and if there's any major differences between an initial and any succeeding valuations that might occur.
So it all depends, but I mean, I encourage clients to get valuations probably every 2-3 years. You never know what kind of opportunities you're going to get. There might be some potential buyers just walking up and say, I'm interested in buying you. Or there could be a synergistic buyer trying to acquire you. There's so many things going on. If you have a partner, you gotta have a buy-sell agreement. So that kind of deal, you gotta have updated value. We see some buy-sell situations and they have a formula in there and it has no relevance to their current value. Sometimes it's based on book value and their market value is way off the chart. So there are so many things that we see that probably requires getting valuations probably every 2-3 years. I mean, it doesn't cost a lot of money to get valuations, right? $8,000, $10,000, $15,000 depends. So every probably 3-4 years or so.
Great. Okay, thank you for all that good information. So April and Krista, we're going to open it up to questions. And while we're waiting to get some questions from our attendees for this great panel on executing the transaction, Mike Chambers, I'd love for you to talk a little bit. Give us an update on the forgiveness of the PPP. If you can give us a quick update on that, and then we see that Jerry, I think Jerry in a moment is going to have a question. But before that question, Mike, can you give us an update on the forgiveness aspect of PPP?
Well, I only get asked this question about 50 times a day, so I can do this one. Listen, I think the SBA tried to signal to us when they said that you have 10 months from the time your alternative covered period ends to apply for forgiveness. I think that was our first way of saying this could be a bit of a long ride. As you know, and Lorraine, you're tapped in more than I am with Washington. They're trying to pull it out of the HEALS Act and make it their own bill. I don't think Republicans or Democrats are fighting over the PPP forgiveness aspect. I think they're fighting over two things: just the dollar amount on which it's just going to be a one-page signature on good faith of a loan versus going through a process, and then making sure they have protocols in place to prevent fraud. I still think that if you're waiting for loan forgiveness, you're probably going to see November, December at the earliest before it actually comes off your books. My best advice to everybody is, while I know we're all type A and we have a lot of angst, they've changed the application a couple of times for forgiveness. They'll probably change the process. Yeah. Your bank will accept them. Partners Bank is accepting. We'll do our good faith review on the caveat that we might be coming back and ask you to go through a different process. So I would, as I started off, just think of it as the, Paycheck Protection Patience program instead of the PPP loan. But I do feel really good that it's a matter of just when, not if, and it's a matter of the process, not the forgiveness. So
thank you so much for that update. And with that, I think Jerry Pyle, do you have a question for us? If you do, you can unmute yourself and address our panelists. Maybe not. Maybe that is for our upcoming panel. Let's see here. Nope. Jim Williams, do you have a question?
Yes.
Oops, Jim, we lost Jim. Right, there you go. Jim, if you can unmute yourself, then we'll have you ask your question.
All right.
There we go.
We sell to the military and we get audited, governmental audits of our financials and so forth. Would those be sufficient, or do we need additional audits beside that? Did anyone hear me?
Yes, we heard you. Yep, we did. Who wants to take that question?
Well, I have a couple of defense contractors as clients, and the federal government's audits aren't the same as a GAAP-based CPA audit, and it's your GAAP-based CPA audit that your buyer's going to look at, and that Michael and anybody doing evaluation is going to look at. My opinion is you need more than just the government-based audit that you're doing as a defense contractor.
Thank you.
Yeah, if I can chime in just one sec. So government audit is they're trying to see what is allowed and what is not allowed type of deal. Whereas audited financial by CPAs, we're trying to gauge what is really cash flow going to look like? What is the owner's equity going to look like? What is the P&L going to look like? So it's a little bit different, like what Fred said.
Mike, do you have any comments on that, Chamber?
Well, I mean, you have to know more about the deal. I mean, typically if you're getting bank financing, they're not just doing it to receivables. You can get a receivable-based loan or of that nature. It typically comes at a cost. But, there's more to the story, Mr. Williams, in terms of if a bank's going to finance it. But when you're talking about someone buying your business, they tend to be a little bit more entrepreneurial, and maybe they do or do not need bank financing, or they can qualify it on their own. But, in theory, if you have government contracts, one thing I will tell you about banks with government contracts, while we are an extension of the United States government, we're also very aware that unlike your non-government receivables, which we could have a legal recourse to go after, we don't have any recourse against our own government. So there is a little trepidation there about being able to collect. So it's a little bit of a complicated answer, Lorene, but for a bank like us, we really pay more attention to the person or people behind it as guarantors than we would those particular contracts.
Perfect. And I think Enrique, I think you're on the line here. Do you have a question?
Yes, with respect to the PPP loan, we were recipients of such a loan, and I've been watching for the news on the repayment application, and I've been given mixed advice. Some people tell me to just wait. Other people to tell me to just go ahead and attest. Currently, if I do the paperwork, I believe our loan will be 100% forgiven according to the current understanding of the rules. So are there any pros or cons for filing right now? Any reason to wait?
Yeah. Listen, I joke. First of all, I have loads of CPAs and wealth advisors as friends, but typically those folks, if you're paying them for their information, they're telling you to do something because you don't pay anybody that tells you just sit and wait. Yes, you can go forward. There's two forms that are out there right now. They came out with a loan forgiveness application that was different than the PPP loan application. And then they came out with what's called an easy form. So if you had no reduction to your payroll, then you had the same head count, and you can decrease salaries, but not more than 25%. If you fit in that category, well, then go ahead and give your bank the easy form. Just know that once the bank looks at it and they put it into the SBA portal, nothing is happening. So nobody on the entire planet, nobody in America has gotten a loan forgiveness. So you're not behind. It's really a matter of choice. I tell folks there is really no disadvantage to waiting. The SBA portal has not been turned on. They have not decided a single loan application. And either way, there's going to be 5.2 million that they got to sort out. My analogy that I've been giving folks, it's like if you're in Los Angeles and you have to drive to Orange County and it's 5:30. You can either leave now or you can go have dinner, leave at 7 o'clock and get home at the exact same time. So my advice is quick.
I totally agree with that, especially if you had to temporarily reduce headcount at all, because the second set of regulations and the statute that passed on the PPP loan gave you to December 31st to restore your full headcount, and that goes towards your percentage of forgiveness. So even if you chose the 8-week period or the 24-week period, those periods have passed, you still get to the end of the year to actually restore your full head count. So yeah, most of my clients are waiting.
Okay.
Right.
Can I ask a follow-up question?
Sure.
Yeah, this is probably to Jessica or Kimberly. With respects to if the business is sold and you got a certain proceeds from the sale, you mentioned that it may be wise to perhaps stretch the payments over time. But now, due to the uncertainty of the tax liability in California, the changes that could occur over the next few months, years, would it be perhaps advisable to just take the lump sum up front and not bet on the taxes not going up tremendously?
Well, I'll just say, as far as anticipating future tax law changes, that's always a tricky one. I never want to play that guessing game. And, when you're looking at a transaction, an analysis should be done up front based on what the current situation and current rates are, because there's always talk about the tax laws changing. It's a regular thing. But if you have that analysis done and you can look at the actual numbers, and then you can make an educated decision based on, okay, this is what my tax liability is going to be if I take this path or the alternative. But either way, it does have to be done ahead of time. So that long-term contract would have to be executed prior to the sale. There can't be any receipt of funds. So it's again, it's part of that planning process.
Yeah, I'd like to add to that, that's where really planning comes into effect, and looking at the what if scenarios of maybe taxes going up which we actually think that they will be going up quite significantly over time, given how much stimulus is coming to the economy. So given all that, you have to do projections. We have to look at that, and then you can, like Jessica said, then you can make an informed decision. So with that, and we're going to talk about that in retirement income planning in just a moment. With that, I want to thank all of our panelists. As I've said before, tomorrow you're going to receive, the attendees will all receive an email where you can ask to receive additional information from all or some of the panelists. So look out for that email. So thank you to our panelists. And now we're going to transition to our